Hello Vision Nation! In this episode, we're going to cover the story of how Blair Hull became a blackjack ninja and cleaned out a bunch of casinos with the help of his blackjack team. His story gets even more interesting because he founded an extremely profitable Wall Street firm that made tons of money in options. He eventually sold his company to Goldman Sachs for hundreds of millions of dollars in the late 90s. Also, I want to give a special shout out to Aaron Fifield from Chat with Traders podcast. Aaron interviewed Blair and was kind enough to let me use parts of this interview for this episode. Thanks, Aaron. Welcome to Wall Street Vision. This show is on true stories about markets and top investors. I'm Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. So Blair Hull always liked math, but earlier in his life, he didn't really have a way to apply his math skills to make big money. He served in the army for some time and later on went on to get his bachelor's degree. He was in his early 30s working as a middle manager at a cement manufacturer when he discovered a book called Beat the Dealer. It was a book by Ed Thorpe.
I did read the book, Beat the Dealer, and I tried to use it, did it myself to some extent. And I found that there was an edge. You could get an advantage playing blackjack.
The book outlined a strategy for blackjack players to beat casinos using the system called card counting. This was Blair's aha moment. He took this as a personal challenge to actually use the strategies he learned from the book in real life. So he practiced like crazy to perfect his technique before his first casino trip. He was feeling giddy with excitement at the thought of making all this money from the casinos. Well, his first trip, he actually ended up losing money. He only played 50 hands, and 50 hands were just too few hands to play. If you're card counting, you need to make hundreds of bets to have good odds of beating the casinos. Now I'm going to explain a few things about blackjack, so just bear with me because this story is worth it. If you've never played blackjack, the goal is to get 21 points. Each card is worth a different number of points. This is probably one of the simplest games that you can play, and each game usually lasts around 2 minutes. That's it, so it's a very fast-paced, quick game. At a high level, the way the card counting system worked is that Blair would keep track of how many big cards like 10s and aces were left in the deck. The cards in the deck were cards that haven't been played yet. And when there's more big cards left in the deck, that's when he'd have an advantage over the casino. For a card counter, the edge over the casino is only around 2%. For a player with no card counting skills, but who is using basic blackjack strategy, the odds are tilted slightly toward the casino.
The best advantage you ever got was 51-49. That means there's a 50, you had a 2% edge. That means for every $100 you bet, you'd win $2.
That seems like a tiny advantage, but if you think about making thousands of bets with a 51% chance of winning, you're going to end up making lots of money. The way Blair played blackjack wasn't really gambling. He had a system that would give him an edge when he played lots of games. Playing all that blackjack taught him a lot of skills that later helped him in his investing career. After 2 years of playing, he was up around $10,000. This was in the 70s, so that was a good amount of money back then.
For the next 5 years, 1971 to 75, I played 50 days a year in blackjack while I still had a full-time job. But every chance I had, I was in Nevada, either Reno, Tahoe, or Las Vegas.
At the time, there were these blackjack teams that would get together and play in casinos. Blair got an invite to a team, and get this, they had a bunch of different exams that he had to pass before he could officially join the team.
The first thing that I did when I learned about the blackjack team is I met the founder, and then I had to go take some tests, some exams. One of the exams was you took a 52-card deck and you took 2 cards out, and then he put a stopwatch and he said, "Ready, go." He wanted you to count the cards and to tell you what the last 2 cards were, and be correct all the time.
Now you might be thinking, why would he join a team? He's already making lots of money on his own. There's a few advantages to being on a team. One of them is you get closer to having more hands played with the odds in your favor. So he tried to join this one blackjack team, but ended up failing their entrance exams. Even though at that point Blair was an amazing player, he still failed because their standards were so high.
I had to take a basic strategy test, and that is what do you do when you know what the dealer has and you know what's your cards. And it's usually a multiple choice question: hit, stand, split, or double. And so I took that test, and I think I got 94 out of 100 right. Well, blackjack really requires that you get all the answers right. You're going to give something back you're going to give them an edge back to the casino. So the fact that we took exams, and there were 10 different timed tests in order to qualify for the exam, led me to be a much better blackjack player than I was originally.
He got such a high mark on the exam, and they still failed him. Their reasoning was that the edge in blackjack is so small that you have to be perfect to make sure that you beat the casinos. Blair had to go and sharpen up his blackjack skills before trying this out again. He studied and practiced daily like a fiend for a whole month before retaking the tests. And this time he passed. Casinos use different types of decks to make it harder for card counters. Blair got so good at identifying these different types of decks that he'd be able to tell them apart from across the room. Playing on a blackjack team is such a high-trust situation, right? You've got 20 players going to the casino and playing blackjack as a team. No one is really keeping track of how much money each person is making, so it was easy for one of the players to pocket some of the winnings. At one point, they were even using polygraph tests on each other to make sure that no one was cheating the team out of money. One time, they even caught a teammate who was playing on 2 blackjack teams at the same time. And this guy was sharing the team's secrets with their competition. The way they played was that there was this one big player and several card counters. They were all working together. The card counters would spread out over a bunch of tables and they would bet small. Then, the card counters would signal over to the big player when the odds were in their favor. So the big player would come by and make huge bets when he had the advantage. It was a great strategy because the big player wasn't doing any card counting himself. So the casino people were scratching their heads trying to figure out how this one guy was coming in night after night and consistently making tons of money off of them. They got to a point where they were playing limit. That means that they were betting the maximum amount on each hand. At a big-name casino today, that would be about $75,000 per hand. So if you're playing 30 hands an hour, that's betting over $2 million an hour. The casinos hired a detective agency to figure out what was happening. It took them around 6 months to figure out the plan. They knew each of the players individually, but then they slowly started to understand that it was a team working together.
We all got barred in 1970, I guess it was early 76.
After their blackjack team got busted, Blair decided to apply his probability models to the financial markets. If you play against the casino and you're really good, they're going to ban you. If you play in the stock markets and you're really good, you can retire on a yacht. So Blair went off to his next project. The famous Black-Scholes model for option pricing was published in 1973. But Blair wasn't familiar with it, so he went on to develop his own similar model in 1975. Can you believe this guy? He came up with this brilliant and useful math model on his own. He just figured it out. So he developed this model and took it to the stock exchange. This was in the late 70s and early 80s, so a lot of stock and options trading was still done in person at exchanges.
And when I saw the exchanges, and the first time I walked down, having been a computer programmer before, having some programming experience, I should say, I knew that when I saw the floor of the exchange in 1976, I said, this place, my God, if I come down here, I better make a lot of money very quick because it's all going to be automated.
At that time, the exchanges were really inefficient. You'd literally have to walk over to somebody's desk at an exchange to buy puts or calls. So Blair ran a computer program that generated these theoretical values for options. This is the same stuff he developed using that model that he invented. The computer program would pretty much tell him what each option was worth. So he would walk around the exchanges with these printouts from the computer. And if he saw an option selling for more than its true value, Blair would sell those options because they were overvalued. And if he saw an undervalued option, he would buy it because those were undervalued.
So I had a value for the option, and then I tried to buy cheap options, and I tried to sell expensive options. That was the strategy.
He was basically a small-time market maker and provided liquidity in the markets.
But I would go around and there would be an option that would be, all the public were going after this option. It was, I had it worth, according to my model, of say 25 cents, and it was selling for $1. And so I had sold maybe 200 of these options, and I'd run around and I'd say, oh, that's such a juicy bet. And then I'd look at the price again. Oh, I got to sell some more of those. And then I'd say, I've already have that bet on the table. I envisioned a stack of chips. And so I wouldn't overbet.
In his first 2 years in that business, he had back-to-back 400% returns. Blair had a rocky third year when 2 back-to-back losses wiped out almost half of his money. He still ended that year with a net profit, but that was an important learning lesson. Managing the size of each individual position was just as important as having a winning edge.
In any kind of a game, whether it's gambling or investing or whatever you call it, there are two things you need. You need an advantage, and then you need to stay in the game. And what blackjack taught me is that I had to bet in proportion to my bankroll. I had to bet in proportion to my advantage. If I had a big advantage, I could bet more money. And so overbetting is the thing that kills you in any kind of game. You can have a winning strategy, but because of the way in which you wager, you can almost be guaranteed to go broke. So it's important as to whether you have an advantage. How much you bet is as important as getting an advantage.
The crazy thing is that he averaged around 100% per year in his trading after that bad year. So Blair was crushing it in his own trades, but then he realized that just like in blackjack, having a team work together would take his results to the next level. Before we dive into the rest of the story, I'll quickly mention that if you're enjoying this podcast, please hit the follow button, and if you know someone who would find this content valuable, please share this episode with them. My goal for the podcast is to help people learn the lessons from the best investors, and to help people understand the stock market better. I think that's important today, as there's lots of information out there that can lead people on the wrong path, and I would love for more people to benefit from this type of content. Alright, back to the show. Blair was reaching the limit of what he could do as a single trader, so just like in blackjack, he wanted to get a team working together, so he founded Hull Trading Company.
Well, I have a philosophy that all great things that happen in our world happen with teams, not with individuals. And I learned that at an early age with the blackjack team.
They used the basic strategies that Blair used in his own trades, but made them a lot more sophisticated.
And so we needed mathematicians and computer scientists to not only come up with the algorithms that would give us fair values, to risk adjust those fair values, and then automate that process to get those prices to the traders. And that took a lot of higher mathematics and computer skills to do that.
He hired lots of PhDs to make his models more accurate, and then he hired tons of computer programmers to make the computers run the models. At the core of it, Hull trading was about finding mispriced securities and either buying or selling them. Basically, they were trying to buy low, sell high, and overall they were also trying to stay delta neutral, which is a fancy way of saying that the firm's goal was to make money no matter what happened to the overall market. So if the market went up or down, it didn't really matter. The firm was hedged, so it still made lots of money. Blair basically applied the blackjack philosophy. If you have an edge and you do lots of transactions, you'll come out ahead.
My definition of a trading edge is that if you do this trade multiple times, you will come out on top. You end up making money. That's the definition. If you did this same kind of trade, whether it was with this chart pattern or with this relationship of these things, and you did it hundreds of times, in the long run, you would have more money than you started with.
The way his company worked is he had 25 traders that executed all the trades. Each one of them was trying to buy undervalued securities, and they were also trying to sell overpriced securities. The prices were always determined by the computer models. Then there was a person in charge of hedging the total position of the whole company. They were like the air traffic controller, making sure that the overall risk for the firm was low. Hull Trading became a massive player in a bunch of markets. They had offices set up all over the world. They were raking in money for many years. In 1999, Blair sold Hull Trading to Goldman Sachs for over $500 million. The cool thing is that Blair is still very active in trading and the markets. Listening to his interviews and reading about him, I really got the sense that he sees the markets as an outlet for his creativity and math skills. It's not just about making money, but it's a way for him to solve this complex puzzle and have fun doing it.
Well, I have this idea that markets do, it's just water seeks its own level, and markets are meant to be more efficient every day. And so that means that no matter what you do, your edge is going away a little bit each day. And that it really takes, but there are tremendous opportunities and quantum breakthroughs in doing things that people have not thought about before. So I do think there are tremendous opportunities. At the same time, whatever strategy you have today is going to be less profitable tomorrow.
My takeaway from this story is that it's important to understand your edge in whatever it is that you're doing. And once you know what your edge or advantage is, it's important to keep working on developing it. For Blair, his personal edge was based on his strong math skills. He used those in blackjack and then in the markets. Another great lesson is that Blair would only take on activities where he had an edge. If you listen to his interviews, he always talks about how he'll never take a bet if it doesn't have an edge in his favor. So that's the sort of philosophy that he has for all of his life. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, and if you know someone who's interested in investing, please share this episode with them. Thank you, and I hope you have an amazing day. This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Before making any decisions, consult a professional. I may maintain positions in the securities discussed on this podcast. This show is copyrighted by the Wall Street Vision. Written permission must be granted before syndication or rebroadcasting.